Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're joined with Gerry Frigon. How you doing today, Gerry?
Doing well. How you doing, Kurt?
Good, good. Well, we brought Gerry on because we're trying to get a bunch of different perspectives this year because of the paradigm shift going on, and wanted to bring on Gerry to talk about a lot of really interesting topics that I know you guys are going to want to hear. So, Gerry, tell us a little bit about your background.
Sure. Well, I've been at this for a fair amount of time, about 37 years. I spent the first 21 years of my career with Merrill Lynch in San Francisco Bay Area, and waited probably 10 years too long to start my own company, Taylor Frigon Capital Management, in 2006. I say we because my director of research, Dave Matheson, and I were both together at Merrill, and we broke away to do this firm together. The Taylor and Taylor Frigon Capital Management is actually my father-in-law, Dick Taylor, who was never a part of the business, and we never had our businesses together in any way, but he was my mentor throughout my years of growth in the business. And he was one of the original portfolio managers back with T. Rowe Price in the 60s and 70s, working side by side with Mr. Price. So we come from a very growth-oriented background. He was my mentor. I learned from him, and he learned from Thomas Price. Which, just in a nutshell, the basic idea is you're buying the business, not the stock. Own companies through multiple market and economic cycles. Our tagline is well-managed companies in front of fertile fields of future growth. So as simple as that sounds, that's the challenge that we have on a regular basis in trying to figure out what are the right mix of companies. We'll own between 30 and 50 companies in our core growth strategy. We also run an income strategy for folks that need more of a cash flow, but still primarily equity oriented, so equity income. And for example, many of our income names are former growth names that just grew up and now are, providing nice streams of dividends and growth in their dividends. So it kind of transfers nice over into that strategy. But that's our short version of Taylor Frigon.
So it sounds like you learned a lot from mentors or people from the past. So I'm curious, what has changed over the years? I mean, I've seen a lot of changes in certainly in my experience in the industry, but what changes have you seen from what you learned originally from your mentors compared to where things are now?
Well, I think one of the things that's changed, and I think is a significant, I don't think it's necessarily a good change over the course of the last couple of decades, is we call it the 8,000 to 4,000 problem. Now it's a little over 5,000, but we went from 8,000 public companies to about 4,000 public companies as of 3 or 4 years ago. Then we got a little bit of a spurt of new companies through the SPAC phenomenon, got up to I think about 5,800, and now you're starting to see that shrink again as this debacle and particularly in growth names has happened, and you're seeing companies again being acquired, taken private. They're seeing the numbers start to shrink back. That to me is one of a huge problems, because it's a sign that we're not creating young, upcoming, innovative companies at the pace we should be. So I see that as a pretty major sea change, and think of that in comparison to when I first came into the business and it was in the mid 80s, through the late 80s, 90s. We were growing companies left and right. Now, some might argue, and I would agree, that as you got into the 2000 era, where the dot-com mess happened, we ended up with too many public companies that probably should never have been public companies. That said, there were a lot of great innovative companies throughout the 80s and 90s that are leaders today, and we're concerned about the lack or the dearth of those new innovators that can become the leaders of tomorrow. So I think that's one of the sea change really that's happened. The other thing, perhaps more on a level that's a little bit more, requires more introspective thought, is we're such a short-term oriented environment. I mean, it's been, I feel as though it's been slowly coming over the course of my now almost 4 decades in the business, where we used to talk about long-term investment and actually deliver that. I think more and more what's happened is Wall Street has gotten so far away from the basic function of what finance should be, which is to provide capital to business, and into the algorithmic world, the short-term gratification world of we're trying to figure out what's going to happen over the course of the next second and make make money on that. And I think that's a significant change that we're having to adjust to. Again, I don't necessarily think that's a positive at all. There's a statistic out there that says that only about 15% of activity in the financial services sector is actually going towards capital formation for companies. So those are two big, and they kind of play are hand in hand. Two big issues that I think are sea changes. And of course, then all of that creating much more volatility in my mind. Now, it's not to say that we didn't have volatility in the past. Not long after I came into the business, I was fortunate to experience October 19th, 1987, which was a pretty darn volatile day. But maybe that was the beginning of what was an increasingly more volatile world. But I mean, we're seeing such wild swings in companies these days in the stock prices that I don't think are rarely on a day-to-day basis fundamental based. So those are some of the changes that I think we've had to face, and it definitely makes it more challenging when you're trying to take a long-term perspective. In some ways, it's an advantage because we can point to, hey, the nonsense of that, and what really matters is focusing on the business and focusing on how that company is moving towards an objective or a vision from a business perspective. That we talk about that all the time. So it could be to our advantage. But I don't think it's healthy from the standpoint of what it looks like and how people who are participants in the market on a day-to-day basis perceive the market. I think the perception is important, and the more and more that people are experiencing these kinds of wild swings, I think it makes it less favorable. It's not a healthy thing.
So I got a few questions out of that. So first, you said that the shrinking market, 8,000 to 4,000 companies. Why do you think that's the case? Like, why not in the past? Like in the past, the markets evolve over the last 100 or so years. So
yeah, I think
has this happened in the past, or is this, like, what do you attribute this to?
I think that this can be directly attributed to a level of regulation. I mean, when you look at in the wake of the Enron situation, we got Sarbanes-Oxley, which was a significantly more onerous set of regulations on companies being public. And and there's a series we could do multiple podcasts on, everything from the NASDAQ trading settlement to Sarbanes-Oxley to Dodd-Frank out of the 08-09 mess. We've had these series of crises in the 21st century, right? Starting off with the bang of .com, and then the horror of 9/11, and then the 08-09, and then COVID. And I think what we are experiencing is it's this typical kind of government reaction to do something, and in the do something part of it, they end up in many ways making things worse, or let's just say this, creating a circumstance of unintended consequences. Let's try
That's
and
a
be
nice way to say
generous.
it.
Well, yeah, I'm going to try and be generous and say, maybe it was all with the best intentions, but the results can be disastrous sometimes, especially over time. And so I think you can point to a number of different regulatory aspects or regulatory issues that have come into play over the course in the wake of Enron. I think that was almost ground zero, frankly, for some pretty serious regulation with Sarbanes-Oxley that made it a lot harder for companies to be public. And who benefits from that, Kirk, is the biggest, right? The incumbents. It's a benefit for incumbency, and so that makes it. We talk to, and we also do venture capital. We have a small part of our business where we run a venture capital partnership, and so we talk to private companies all the time. And it's somewhat unfortunate that a lot of private companies just they don't necessarily want to be public. The exit is to go grow up and then be bought by a big giant firm. Well, that's just not healthy. We need small companies to be public companies, to grow up and be bigger public companies. And the M&A stuff is going to happen. That's all fine and good, but when that's the primary objective, most, I will say, most private entrepreneurs that we talk to are fearful of being public companies, and that's not good.
Do you think that I kind of think about this from different angles, right? And the problem of regulation is huge, right? Is that the big companies, they want regulation, they want higher barriers to entry. They don't, they have their seat at the table. They don't want someone coming up and taking it. But I see some of the challenges from the tech sector is, these companies, they're, like you said, their goal is to not be the Facebook. their goal is to get bought by Facebook. So they,
Yeah.
they try to, like, how can we increase our revenues as quickly as possible, even though we're losing money, and hopefully someday someone will, buy us out or we'll go public. To me, you don't have the old world companies coming up, in a slow and steady manner like we used to. So, I mean, I don't know if it's a problem or if it's a problem of low interest rates, right? I mean,
I
if you
think
have,
it is.
you have
I think
0% money.
I think you're absolutely hitting the nail on the head right there. Now, we have since the advent of 0% interest rates has said this is a misallocation of capital. It's creating a misallocation of capital. You can't price time at zero forever. And we got into that mode. And, now we're going through a period, and we're going through a period, obviously, of one of the most rapid increases in rates the Fed has ever embarked on. And, it's obviously hurt us dramatically from the standpoint of the way the market perceives that on growth companies, and all the models for, asset pricing models get messed up with higher rates. But the reality is this is something that likely needed to happen. I don't necessarily like the fact that they're, targeting the economy. I mean, these are Phillips curvers that think that you have to bring the economy down to its knees and create unemployment in order to stop inflation, which is just a complete misunderstanding of what inflation is. It's too much money chasing too few goods, and when you increase the money supply by 42% in 2 years, you're going to get inflation. It had nothing to do with people going to work. But that's that's the world that we live in, and we might want it to be different, but it's the hand we've been dealt, and we have to play it. And I think, yes, it's created significant dislocation in the 0% interest rate regime for so long. And I would even go back to not just the most recent one, but even the early 2000s, which, I don't think we actually got to zero, or at least not for very long, but rates were really low, historically low, for a period of time there before the 08-09 mess that created the bubble in housing. And so what it's doing is it's creating these, this kind of also gets to the point of, too much, not enough of the financial activity going towards capital formation. It's going towards all these gimmicks and games. This all ties together. It all plays together. When you've created a situation where you've made money abundant and not economic growth abundant, then you're going to have a problem. And that's what we've got. And so, we now think, and one of the dangers, right, of 0% interest rates is the Fed then has to react abruptly and risks overshooting. And I think that's probably where we're at now. I can't say that I blame them. I think they're doing it for the wrong reasons. Like I said, they're Phillips curvers, but I can't blame the Fed for being, frankly, angry about the position that they were put in by Congress for spending $12 trillion over a few years. And it's like, well, where are we going to get this money? All the Fed will create it for us. I mean, if you think about it, it's pretty disastrous from their perspective. And so it's almost like this is their revenge. I hate, I'm sure that's not necessarily the case, but it could look like it, and maybe it is. But the point is that these are dislocations that create misallocations of capital, that give us 4,000 public companies instead of, we should have probably 16,000 public companies. And yeah, the regulatory environments hurt the small businesses and hurt the up and coming innovators. What's remarkable, and we can, so far we've started off quite negative. What's remarkable, and this is where we see opportunity, is that in these periods of time where you have these kinds of dislocations, and my father-in-law used to talk about this in the 70s. He used to say he made some of his best money in small cap growth companies particularly in the late 70s, and then turned into really good mid and large cap companies through the 80s. When you have these kinds of dislocations, it's interesting because all of a sudden you will see the real innovation start to rise to the top. So when you talked about, the typical private company's way of approaching things of, let's grow our revenues as fast as we can at a loss and get Facebook to buy us or Google to buy us or whomever. I think that ship's now sailed. So good luck with that, because I think we're living in life after Google. My friend George Gilder's book, read it. It's an excellent one, about, the next wave of compute that's away from the data center, the massive centralized data centers. I think that as that starts to play out, you're going to see where real innovation is rising to the top. And that's where there's opportunities. Right now, the noise is still blocking it, and so you're not able to see quite as clearly who the real innovators are. They've been there all along, but they've been sort of hidden or stultified by all of the noise that's been going on. And so I think that as this plays out, and it's ugly while it's playing out. In fact, we've talked to clients over the years as we've talked about, say, life after Google has been about a 4 or 5 year phenomenon for us. And we've told clients this is going to be a painful process as we go through it. And we don't try and pick tops and bottoms. So we're just going to own things through it. But on the other side of this, you're going to see where the real innovators start to shine. And I think that's beginning. I think even if you take the crypto blow up, which frankly was not a crypto blow up, it was a good old fashioned over leverage and maybe even fraud blow up. If you look at what's happening there, one of the good parts of that is that it's shaking a lot of the nonsense out. And what the crypto / blockchain ecosystem has to do is prove its utility. And that's now, I think, going to start happening. You're going to start seeing more and more of these platforms that have been growing under the surface with a lot of very, very bright, some of the brightest technology folks in the world working on these blockchain technologies that are starting to show themselves as being real utility. And it's early yet, and it may not be quite as visible. And again, we could probably do 3 or 4 podcasts just talking about that. But that's where I think you're going to start seeing some things really come to the surface. And the ship will find a way to right itself at some point. I mean, will we ever get to a point where we're truly a free enterprise system? Hopefully, we're not right now. Fortunately, we're not China or the former Soviet Union, but we're certainly not as free as we should be as far as free enterprise is concerned. There's still a cronyism aspect to things that as we said, let the incumbency reign and have more power. And so I think as you're seeing some of these, whether it's the political upheaval that's gone on or even the economic upheaval, I think somewhere in this you start to see the good and the innovative start to shine, and that will then be the impetus for change that will help to get things back on a track that is moving back towards a more favorable free enterprise system.
So, one thing I wonder, because you mentioned you're more of a growth oriented, you look for growth companies. Obviously we're in a growth environment for like the last 10 plus years, up until last year, which I think pretty much anything didn't do well, although value did a lot better. So I guess, I'd be curious to your perspective on the kind of the growth versus value orientation in the last few years, and where you think things are going in the future if we have higher interest rates.
Well, I think ultimately growing businesses are a hedge against inflation. So it's a little bit oxymoronic to us that we see this reaction against growth companies. I think really, we're getting is a lot of these companies that were really great companies got ahead of themselves on the valuation side, and they got their comeuppance. Now it's gone to the other direction. I kind of look at the growth versus value debate as being somewhat of somewhat silly. And even Buffett's talked about, I find value in companies that others might think are growth companies and vice versa. And there's, Lord knows, there's a lot of software companies out there right now that one might consider a value play. And plenty of them are in our portfolio. I mentioned the ones that have had the biggest growth in revenue over the last 3 years have generally been software companies. And that's not necessarily even waning much as we see digital transformation taking place. And that's a very important, narrative that I think will continue to be a super important thing, especially in a slower economic environment where non-technology companies are having to adopt more technology to make themselves, efficient and able to survive, for that matter, in an environment like we're in and probably going into. But as far as the growth versus value debate, look, I said offline earlier that we look at the income statement first and the balance sheet second. And what we would consider to be traditional value players are more interested in looking at a balance sheet and saying, well, what do they own that is not being valued properly in the market? And that was kind of a traditional value approach. My father-in-law used to talk about the great value plays were taken out in the leverage buyout craze of the 80s. And so you lost a lot of that, what was traditional, ownership of assets that were being undervalued in a company's stock price. And so you're looking at the balance sheet and saying, hey, we can buy this and, maybe spin some of these things out into other businesses, or, we can turn the real estate that this company owns into something more productive and therefore gain value out of that. So to me, that's more of a value type approach. That's not something we would ever do, but those don't exist as much anymore. So in a lot of ways, what I see value as being is more just cyclical plays, where you're trying to buy things they're on the cheap, and hope to get a value rally that then you can sell it. And that's just contrary to the way we think. We're thinking in terms of buying a business that we would own through multiple market and economic cycles, and to be participating in the growth of that business. So to us, value lies in, for example, a company is maybe doing $500 million in revenue, and it's trading at $3 billion, okay, in market value. But it is a market that is either creating, it is in a market that is either creating a whole new market that we think could be a $50 billion business, and therefore buying it at $500 million in revenue and $3 billion in market cap to us is a value, versus a company that might be doing 50 billion in revenue and is trading at 300 billion, and we're hoping maybe it's gonna maybe somehow it's gonna do enough business in the next business cycle that it'll get to be a $55 billion company and we can sell it for 400 billion. So it's just a different way of thinking about it. So for us, value lies in, if this company is doing $500 million in a market that could be 50 billion, to us, that's cheap. If I can buy it for $3 billion, because I'm pretty sure if they get 10%, if they get to 5 billion in revenue, they're not going to be trading at 3 billion anymore. Maybe there will be some contraction in that revenue multiple, but I'm pretty confident they're going to be trading at 15, 20 billion in value. And I've just got myself a pretty darn good investment over the course of the next 10 years.
But if you're looking at like history, and I know we're all we have our kind of recency bias, but if you're looking at history, the valuations are off the chart, or they have been. I mean, they're definitely, they've come down over the last year, but they're still really high compared to history. So do you think we're in a new paradigm where we're just going to continue with these high valuations indefinitely, or do you think we could come back to a point where, like in the 70s, where interest rates were 15, 20%, depending which, rate you're talking about, and, money was really expensive, which of course is one of the reasons why it was cheap. So, do you think we could get back to a place like that, or what are your thoughts?
I don't really see that. I don't think I think the reaction now has been pretty violent. Also, on the upside with interest rates, I think they've done the job. If you look at the money supply, it's now rolling over pretty fast. It's not going to, get back to where it was overnight, but we've got a pretty good reduction in money supply going on right now, which is likely to slow the economy, which is one of the reasons why we need some real pro-growth policies in there to help the economy along in this period of time, which we won't get. But that's what we need. But again, I mean, as far as valuation, I mean, it's in the eye of the beholder. I just gave you a valuation metric that most people probably don't think about. You're thinking about price to sales, price to earnings, whatever that metric is, dividend discount models. And we will look at all of those, but at the end of the day, those are snapshots right now. I could go through a period of time where there's valuation contraction, but if my business is growing at a level that I just described, and we've seen that over and over and over again in our history, where that $500 million company becomes a $5 billion company in revenue, and that $3 billion market cap is a $15 or $20 billion market cap, and it's not the same relation in multiple anymore, but I got a pretty darn good return. So at the end of the day, that's what we're far more interested in than traditional valuation metrics, which can be fleeting. I mean, the best companies in the world oftentimes have never been values. You look at Amazon. I mean, Amazon was a phenomenal return for us over 12 years. And it was never cheap in the whole period of time we owned it through. We sold it like in 2019. Um, had we used valuation metrics in the case of Amazon, we would never have owned the company.
Yeah. No, it's interesting because I see, there were periods in the 70s being one of them, and certainly 2003, you could have bought Amazon for pennies on the dollar. I forget what it was,
Yeah,
like
29
$3.
cents.
Yeah, it's really cheap. And Apple the same way. Like, there are
Yeah.
a lot of companies that you could have gotten really, really cheap. Um, so I guess the question is, and obviously if you miss it, then it's always expensive all the way up, right? There's that problem. Yeah, I guess I just wonder, when we're kind of thinking about this, like, tech has been the center stage for a long time, and people think that, it's tech all the time, and, basically buy FANG stocks and forget, which, we're in a different paradigm, which leads me to kind of the next area I want to talk about, which is kind of inflation. Um, Obviously inflation changes the dynamics of the equation of what's attractive now. I think we saw that last year, especially with NASDAQ stocks. So how do you think inflation is going to, now I'm asking you to make a predict the future for me, Gerry, but, what do you think inflation is going to do to the paradigm of investing in stocks?
Well, I mean, inflation is always with us, right? I mean, the Fed targets 2% inflation. They're probably going to increase that. I don't know what to, but maybe it's 3%. I don't know. We're always going to have inflation as long as we have a fiat money regime. They never will get that completely right. But again, it's the hand we're dealt, so we have to play it. I think we will likely be in a higher inflationary environment for a while. Higher meaning, does it mean 15, 20%? No, I think that ship has sailed now. I mean, the Fed is clearly not going to accept that, and almost so much so that it's willing to sacrifice economic growth to accomplish its objective, which I think is unfortunate, because I think you can fix both. I think you can fix inflation with economic growth. The problem we have now is we're not going to get enough economic growth because most everything that we're doing from a policy standpoint is to stultify economic growth. That
Hold on.
said,
So before you go in, I'm curious about this. So how do you think they're going to be able to do both? Because we talk about this dilemma on the show a lot. So I'm curious in your thoughts on how you think they can do both, grow the economy and get rid of inflation.
well, I think they could do both, especially if we had more favorable policies and reduce some of this regulation that's on the backs of businesses. I don't think that's going to happen. So that's going to be a bias towards less economic growth. But I think what you could end up with is a weak economy, inflation that's above average. I don't think we end up with the kind of inflation that we had in the 70s. I just don't see that. I think they waited a lot longer to react than what we've just done, and we've just experienced a pretty significant and abrupt rise in rates. I think that what we're going to end up with is a relatively slow economic environment. Probably good economic growth for us now will probably be 1.5%, maybe 2. And we're going to end up with higher inflation on average. So instead of 2%, maybe it averages 3%, 3.5%. I think they will get that target down. It's not going to get down from 6, 7% to 2 to 3%, in 3 months. But I think they will ultimately get there. I think they're hell bent on it. And so the problem is that if it were my if I had my druthers, it would be I would create every possible circumstance I could to spur economic growth and let the inflation take care of itself that way. So right now I think they're doing almost the opposite. At least they're not being so profligate with money now that that we're just reliving the same thing we lived through in 2020, 2021, as far as money being flown out of literally helicopters, I guess. At least they're not doing that. But they're not fixing the regulatory regime that's really hurting small businesses and small business formation. Now that could change too. I mean, it changed in 1980 pretty abruptly, and it ushered in 20 years of fairly solid, low inflation economic growth. So I'm positive that. The other thing is even in the 70s, as I said, Dick Taylor talked about making some of his best returns in small cap growth in the 70s and early 80s. from these kinds of environments. That's what I want to return to what I had said earlier. Some of the greatest innovative companies have been born and have grown up. So I think even if there's, we don't do macro looks, we're into buying businesses, and businesses that are well run and have innovative products and services and are able to be in front of fields of growth, they will do well regardless of whether the economy is super strong or weak, or whether inflation is strong or weak. Probably the thing that is it will be a concern at some point if the Fed doesn't back off a bit, is we start ending up back in a deflationary type of situation again. I don't think that's going to be anything that would ever be long lived, because they won't allow it. I think 08, 09, we went from a monetary policy of scarcity to a monetary policy of abundance, and I think that's going to continue in any sign of trouble. But right now, I think their tolerance for trouble is a lot higher, based on what, as I said, it's the anger of the last 3 years that they had to deal with $12 trillion of profligate spending.
So I had a few more questions before we wrap it up here, in kind of looking at the bigger picture. And one is, I know this is kind of a dated topic now. No one's talking about it anymore. Very few people are. Well, some people are, but they're kind of sick of it, as ESG. This is one of those topics where you get a ton of support from specific parts of the economy, and other people just saying, "Oh God, leave us alone." So what's kind of your thoughts on ESG? Kind of how do you see it?
We're in the "oh God, leave us alone" camp. ESG is nonsense, and ESG is dead. ESG is a construct of the progressive left, and it is time for it to have the stake driven through its heart. There's nothing about that makes any sense. If we can't figure out how, after decades of subsidies for things like solar and wind, to make it profitable, I got news for you: it's not going to happen. And so, it's pretty disgusting when you think in terms of how well we've progressed technologically to be able to burn clean natural gas, to think that we're getting, the kind of garbage that we're getting from the ESG crowd is just, frankly, it's criminal. There's places in the world where people are starving to death. They can't feed their family, and we're sitting here lecturing them on ESG. I mean, it's disgusting. So I am firmly, and we are firmly in the camp that this needs to end, and we need to get back to growing the economy. Growth in the economy is good for the environment and good for air quality and all of that. The dirtiest, most scummiest places in the world are places where economic growth is non-existent.
Yeah, what I find interesting, or most interesting, and politics aside, is that the hypocrisy of the people promoting ESG are also not promoting nuclear, which is one of the cleanest forms of energy out there.
Amen.
It's shocking. I mean, we talk about it in the show, maybe, I don't know, once every 2 months, about nuclear, and there's very few people talking about it. But to me, it's just a no-brainer of, if everyone wants a cleaner planet. Let's be honest. Like,
absolutely,
we're all for that. No one wants a dirty planet, right? Like let's get beyond that, that imagery. But people want cheap, clean energy, and that provides it. And yet the certain groups that want ESG, they have no interest in nuclear. None. It's mind-boggling. Yeah. I mean, if they really want to make a difference, that's how you make a difference. But they don't want to touch
definitely. It. I think there's actually some good movement on that, Kirk. You may have seen some of these micro nuclear technologies. I think that is the future, and I think at some point the average person is getting. We got to give the average person out there more credit. They don't pay attention a lot, and this is how things like this start to grow. But I think that average person is looking at this just like you are right now, and saying, "Are you kidding me?" And eventually they will prevail. The common sense will prevail. This is a few very wealthy, the largest of the largest, who, it's the Davos crowd that, thinks that they can, make all the decisions, and by the way, along the way, will be the ones that own everything. You'll own nothing. I mean, give me a break. So yeah, I think free enterprise and freedom will rear its head, and the average person is hip to this now. That's why it's dead.
Yeah, no, I agree. About 6 months ago, we started to see it kind of go into a tailspin, and just you didn't see the same push you saw in the years prior. I think it's what's interesting is if you see like periods of abundance and excess, kind of like what we saw up till 2021, just like everything was easy. And it's really easy to put extra money into, clean energy because, hey, you've got enough money, so why not? But when you're starving, when you can't pay your electric bill, clean energy takes a back seat, right, to survival.
Absolutely. Well,
So,
but the thing is that I think let's be honest though. This stuff that's purported to be clean energy is not. I
right.
mean, it takes all kinds of resources, all kinds of rare earth minerals, all kinds of things that require massive energy usage to build these windmills, to do these batteries, to do all of these things. And then what do you do with them when they're no good anymore? I mean, there's all kinds of problems with this. And I think that, this ties into the 8,000, 4,000. It ties into lack of capital formation. Only 15% of financial resources going to start new companies is because these fat, dumb, and happy giant companies start looking around and seeing, what's the thing that's going to, attract attention now that maybe we can, make our next wave of money on, and they buy into this kind of nonsense. Well, if we were in an environment where they had to worry about the fact that if they're sitting at Davos, there's a young upcoming company that's going to, kick their butt because they're more innovative and creative in how they're doing things. That's what we need to get back to.
Yeah, no, I totally agree. I think innovation is the solution to a lot of our problems. So
Yep.
as we wrap it up here, Gerry, what are some final thoughts we can leave our listeners with?
I think stay the course, and understand we're a company that owns companies measured in decades. We don't have a problem owning things through these kinds of debacles. And we have found, while it's painful during the process, and that's not to say that you don't do reasonable rebalancing, and we will do that. We own 30 to 50 companies in our core growth strategy, and we will rebalance regularly to make sure those are relatively even so things don't get out of hand. But for us to own a company for 15 years, 20 years is not unusual. And we think that this digital transformation narrative is really important, as the rest of the economy that has not spent the last 30 years adopting technology, the non-technology companies becoming technology companies, if you will, is a really, really important, and there's a real important phenomenon, and a really a big opportunity for investment. So is technology the only thing that you can grow? No, not at all. However, it is ultimately the place that innovation comes from. And we're finding more and more, really super interesting medical device companies, real super interesting, companies that are in the consumer products world that are doing things differently. And so pay attention to that phenomenon of digital transformation. I think that that's a really important theme, if you will.
Great. Well, Gerry, thanks for coming on the show. Where can people
Thank
find
you
more
for
about
having me.
you? Where can people find more about you?
Oh, yes, taylorfrigon.com. And also we have a podcast, our long only podcast, if you want to follow what we're saying on a weekly basis.
Awesome. All right. Well, thanks again for coming on the show, Gerry.
Thanks, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Gerry. Really appreciate him coming on the show. Now we're into the panel portion. We have our very own Doug Heagren. Hey, Doug.
Hey, good morning, Kirk. How you doing today? Hope things are warming up in your part of the world out there.
Thanks for the bad news, Doug. It is now 50 degrees, and my backyard ice rink has turned into a winter pool once again. So thank you very much for your weather.
You can always do water hockey,
water polo,
water
where
polo.
the horses.
That's right.
All right, and we also have our very own Barb Friedberg. Hey, Barb.
Hi, hello from sunny California.
Thanks for that, Barb. So let's start with you, since you're all sunny and cheery this morning. What were your thoughts from the interview?
Value versus growth. What the heck is it? Is it important? Do you need to pick a side? Well, not really. Number two, number of companies that are shrinking in the US. Yes, it's true, but there's more to the story. And number three, ESG. What is it? Is it a thing? Does it matter? And pros and cons.
Love the cliffhangers this morning, Barb. This is fantastic, setting us up for great conversation. Doug, what about you? What were your takeaways?
I mean, those are the three main things that he spoke about. And I think that there's plenty to expound on that. I mean, value versus growth, something we've talked about in the past and certainly can touch on a little bit today as a takeaway of his conversation. I think for me, more interesting is the focus on and around the pros and cons of ESG and kind of where it has evolved to, or you might say, based on his comments, where it has failed to evolve to. As well as, this topic of public and private companies. And we've talked about this before, Kirk. There's been less IPOs. There has been less public companies to invest in. That data is plentiful. But I think there is a lot of questions about what does that mean? And what does that mean not only for the direction of entrepreneurs and businesses, but what does that mean for investors as well?
Yeah, no, that's a great point. And I'm going to go back to you, Barb. We'll start with a public company one because I find that fascinating. I think a lot of the trends you see, the data are interesting. I've seen data that said, well, the holding period of stocks has shrunk since like the 80s. And, and then you look at like the last 15 years and it's like, wow, it's really gone, really short term for holds. But then you got to ask the question, well, are they including like high frequency trading in that? Like, is that skewing the data? Like, you never know. It always comes down to the data, right? To garbage in, garbage out with data. So, what are your thoughts with this? I mean, the decline of public companies, shrinking markets, is it bad, or what are your thoughts?
That is a really good question because, yes, it is a fact there are a declining number of public companies, but that doesn't necessarily mean that it's a problem for investors. As anybody knows, during the past 10 years, X out last year, you can make plenty of money given the number of public companies there are. So don't get all worried that, oh my gosh, there's not enough companies to invest in. There are plenty. And also there's some other things that are not mentioned. I recently read a McKinsey report where they discuss, yes, public companies have dropped, but it's not as dire as it looks because many of those declining, first of all, it's cyclical. The number of companies, public companies in the US goes up and down. We're in kind of a trough now. Also, many of the companies that have dropped out of the list are those that were acquired. So they're still there. They're just in another format. They're within a bigger company. And also, there's a changing dynamics in our society. We've got banking, industrials, and technology have the greatest impact on the declining number of companies. So, yeah, it's falling. Does it really matter to the individual investor? I don't think so. Their increased regulations make it tougher for some companies to want to dive in. Maybe that's a problem for the smaller companies. But other than that, it doesn't really affect the investors one way or the other, in my opinion.
That's a great perspective, Barb. We really appreciate that. Doug, what about you? What are your thoughts about, the decline of public companies, shrinking markets?
Well, I would agree. Whether or not it actually affects investors' ability to invest, I think is irrelevant, because there's the things you can control and the things you can't control, right? The decline of public companies from an investment standpoint just means that you're going to have to pick from what's remaining. But I was going to say who I think this would be more difficult for is it would more likely be more difficult for the investment managers, right? And we've seen that over years with active managers struggling to be able to achieve results that have equaled, if not surpassed, what indexing has been able to accomplish. And I think where the decline of public companies really needs to be investigated, and I haven't done the research on this, is where is the biggest declines happening? If the biggest declines are happening in the large in kind of a sector space, right? So we're seeing less maybe in technology than we used to. That might make it harder to find opportunities in that space. If it's large caps that are shrinking, well, there was only so many large caps anyway, and there was already a struggle to outperform large cap indexes if you were an active manager. Trying to figure out which ones are going to be the ones that are going to thrive and the ones that are not. Now, if the bigger consolidation is in the small cap space, I mean, the small cap world is riddled with a tremendous plethora of more companies out there. I mean, there's way more companies that are small than large. So because of that, I think that if there is some consolidation that's going to go on of less public to private, I do believe that there's probably going to have maybe even a better opportunity to potentially, as I've said before, see active management or people that can actually weed through that data and find the companies that are actually going to be healthy, that are going to be potentially able to grow or at least be able to thrive long term with less disruption. Listen, from the 1990s to 2016, the number of publicly listed companies overall dropped 52%. But despite of all of this, and this is according to a Forbes article, the Global Entrepreneurial Index, which is a measurement of how attractive economic environment is to entrepreneurs, lists the United States as #1 in the world. Okay, so for all the things people want to complain about, it's still, and all the regulation, we're still listed as the best place to start a business in the entire world. And I think for anybody out here that is a business owner, as much as it might be frustrating, and there are increasing number of stringent regulations and an increasing number of risks that going public is going to take, most of which is having to derive and direct your company based on short-term information of shareholders and analysts and private equity, which makes it much more difficult for a public company to think, months, years, decades, right? They're always thinking next quarter. But yet, besides that, all of the business owners that are listening to this, ask yourself how easy it was to go out and start the business. It may be challenging to run the business, but you can start an LLC for $250 and you can do whatever you want in this country. And I think that right there says that entrepreneurship, whether it's public or private, is here to stay, and it's still going to be a credible opportunity no matter what the obstacles are.
Yeah, I think that's interesting. Before we move on to the next topic, I have some thoughts on this based on, kind of what you both said. I mean, yeah, the U.S. is still the best place to start a business, but I would argue that just because you're the cleanest dirty shirt, it doesn't make it clean, right? If it's dirty, it's dirty. And I think the challenge with starting a business is many countries, it's really, really hard. I mean, like India, there are a ton of small businesses, but there's an enormous amount of red tape. And there's so much untapped potential in a country like India. I've studied this a lot, and it's amazing what's there. But the amount of red tape there that they have is ridiculous, and it hinders starting a business. Here, like you said, Doug, it's really easy to start a business. I think the challenge that, and this kind of ties into one of my other points, is the challenge is when you have fewer companies, it's the environment's less competitive, right? You go back to like Econ 101, for those of you who took it in college, you probably remember, like, what is the most efficient market? Well, it's like, a virtually unlimited amount of companies at the same size, like all a bunch of small companies. What's the most inefficient market? A monopoly. And so, if you think about that as a theme, right, is we're going to fewer and fewer companies, it just means that the companies are getting more and more bloated. There's less efficiencies. They're probably not as good as maybe a nimble company that's going to start up and eat somebody else's lunch for them. Like that, like creative destruction that happens in the markets is really important. And if you don't have it, then it really kind of wrecks the returns of the market as a whole. Now, all that being said, none of us have to worry about that because the trend is a long-term, slow-moving trend. And should you freak out because you saw this data? Absolutely not. I mean, you probably will be dead by the time that this matters. But the trend is important because if it continues to go in this direction, then the companies are going to get less and less efficient. And if you think about like the big tech companies, there's only one. There's only one Amazon. Well, I shouldn't say that. There's really only one Apple. There's only one Tesla. Like you look at these companies, and yes, there can be more than one. There can be more than one Facebook and Twitter, but there aren't. Like, where's the Twitter clone that's gonna take their lunch from them because Twitter wasn't doing a good job? There isn't. So the thing with big tech is there can be only one. Go back to like the Highlander thing, right? There can only be one. It's the problem with tech. And so at some point, if you don't allow that creative destruction to happen, then effectively you're not going to get rid of Meta if they're doing a bad job, right? They're not going to disappear because they just can buy up competitors constantly. And I think I think as an economy, as a stock market, you need to have that. And the fact that is slowly disappearing is a problem. Now, I will say, I think that a lot of that has to do with the fact that we had low interest rates, and it makes it really easy to borrow cheap money at low interest rates. And so these big companies just borrow money and buy out their competitors. So I think that part is changing, which is a good thing. So you may have less of that going on, and maybe even some spinoffs at some point, which tends to happen in high interest rate environments. But I do worry about the homogenized returns, in that we already have this problem, as you said, Doug, in the large cap space, where it doesn't really matter what you invest in. You might as well just invest in the index, because large cap managers are pretty much, I don't want to say worthless, but the returns are mimicking the S&P 500. So why bother taking a chance on a manager? And I think that problem is just going to continue unless you have this, unless you have more competition that's going to force them to actually be competitive and efficient. And look at GE. I'm mentioning a lot of companies, and I have to put a disclaimer at the end of this, but you look at GE, it was like the original, one of the last Dow stocks, and, GE kind of almost disappeared in 2008 because of, the way they structured things. And, that stinks that almost happened, but that's a good thing. You need that. You need companies to be able to fail and that to happen, because if you don't, then you end up like some of these other countries where they're not allowed to fail, and the companies just become, inefficient, and they might as well be a government enterprise at that point. So I don't know, but let's move on to the next topic. So Barb, growth versus value. What are some of your thoughts on that point?
This is a big one, because growth, which means companies that are labeled to grow really fast. Those companies have done a stellar job during the past decade or so. And again, let's not dwell on 2022. We all want to put that in the rear view mirror. But growth companies poised to grow very quickly. Growth companies typically have higher valuations, which means they are more expensive to buy if you measure them according to how much you're paying per dollar of earnings, or the PE ratio. Value companies are typically, quote unquote, more fairly valued means they're cheaper, they're slower growing, sometimes they've got a problem. So that's the difference. Now, there's a lot of research in the past, again, because that's all we have is the past, that says value is a good idea because at some point a value stock will come back to fair value. So you have a chance of making a really good profit. Well, despite the fact that I'm pretty much leaning towards being a value investor, that's not always the case. Sometimes stocks are undervalued for a reason. So what does that mean for you, the investor? Okay, we've gone over what's the difference. What should you do? Well, I kind of go with, have a balanced view. You probably should have a little value in your portfolio. You also should probably have some growth because a stock can be overvalued for literally ever. If it's a really popular, strong company, it can just keep on growing. So in terms of investment strategy, I say, why not split the difference? There are different approaches. If you buy we're talking a lot about market index funds. If you buy a US total market index fund, you're going to get value and growth.
That's great advice, Barb. Doug, what about you? What are your thoughts?
Well, there's a lot to dissect on this, and there's a great article that Schwab has put out. I'll try to get it over to you, Kirk. It might be something as a good reference, but they talk about growth versus value. And what's really interesting is, the idea is that if you take a look at growth, growth is one of those things where large cap growth has reigned supreme for, since 1995. It's really been driving everything. But what's interesting, if you look at the chart on that, you can see that it really started to take off in terms of cumulative percentage performance against the S&P 500 minus S&P 500 value. It really popped up until, of course, the dot-com implosion, and then it fell right back to earth. And not only that, it actually ended up going negative. Then all of this QE money, right? All of this easy, cheap money that we've seen since the Great Recession, which was really at the, when that recession hit is when value really ended up, growth ended up going negative. You follow that since then, and it has popped significantly with, just unchecked expansion until basically the last couple of years. But what's really interesting is also, again, understanding what is it? Because if you mind the sector weights, S&P 500 growth is dominated by information technology, right? So when you're buying growth, what are you really getting? For the most part, you're predominantly getting, consumer discretionary and information technology. And there could be some crossover there, right? So is Tesla information technology, or is Tesla a consumer discretionary? Is a healthcare company that's in biotech, is that healthcare, or is that, information technology? So there's some crossover there. The other thing that you're also seeing is that there's been a pattern since early 2000 of shrinking growth and rising value. So the number of S&P 500 growth companies in the growth index peaked out, roughly about 350 in 2014, and it's actually been shrinking since then. And it's actually down to as low as it's been since 2005. Simultaneously, the S&P 500 value has actually been growing the number of stocks. It's at its highest level since 2000. It started at 2000 just under 380. They're now close to about 450 stocks in S&P 500 value. And I can see this personally. My wife works for 3M. I remember looking years ago and seeing 3M was a growth stock. I'm thinking, they've been around like 100 years. They're pretty established. How were they a growth stock? But there was this view that they would continue to expand and dominate, in whatever sector they did, that they were so multinational, kind of like GE that you were talking about. And now we're starting to see, well, wait a second. They're starting to, they're actually acting like a growth stock and pull back now, but yet at the same time, they're an incredible dividend. People are talking about how their current stock price compares to value. I think what we're seeing is, and as Schwab puts it, unchanged growth and shrinking value, that it's getting harder and harder to really even understand through bubbles and cycles, where the line is drawn between value and growth, and that there's actually, like kind of Barb was alluding to, there's a tremendous amount of overlap in those index and sectors of entities that would be considered growth or value under previous definitions.
One more thing. a company also can shift. The same company can shift to be a growth company at one point and a value company at another. Let's say there's a really speedy grower, and then boom, bad economic news, a recall where the stock price tumbles. That former growth company is now a value stock because it's cheap. So if you're a stock picker, what you want to look at is, what are the growth prospects going forward? Does this company have means to drive its revenue, to grow its profits? And then the price you're paying, does the price merit that growth?
Hey, Kirk, I want to add on that because I think that's a really good point, this shifting. But I forget who we were talking about on the panel probably a couple of months ago. The gentleman that actually was trying to buy, talking about buying leverage or buying companies, and how during the age of cheap and easy money, it actually was a negative in companies' valuation, that Silicon Valley, that the venture capitalists didn't want to invest in profitable companies. Do you remember this conversation we had? They preferred them to be actually low profit, low free cash flow. This one of the same charts that actually is that Schwab has since January of 2021. It's almost a mirroring effect between information technology cumulative percentage performance of free cash flow yield versus long-term growth. Literally looks like this. When the free cash flow yield went positive, the long-term growth perspectives went negative. When the exact opposite reverse correlation, when the free cash flow yield went negative, then the long-term growth went positive. It's an incredible observation to see at how much having free cash flow, and maybe just the view of, well, what are you doing with it? If you've got this free cash flow, you're not investing it enough. You're not going negative on your financials enough to try to drive that expansion. It actually is viewed as a negative when it comes in the investing world, in terms of what they view the opportunities for that company to be. It's actually considered to be a bad thing to be profitable and have free cash flow. Head scratcher to me, but again, you're talking about efficient markets and rational investing. Does that even exist? That's a good question.
Well, I think it's a great point, and I know in the last few years we've kind of been in the twilight zone of finance, where Apple had this huge amount of cash, and then some investors came in and said, hey, you need to start paying out a dividend. You need to start doing this. You need to start doing that, which isn't always a bad thing, right? Investors want what they want. But I think that, the investing space has really changed. Look at private equity. Private equity was looking for basically companies that wasn't just private, well, mainly private equity, but they were looking for companies that they could say, all right, you're losing money. How can we help you lose more money so you can grow faster? And then you look at like a company that's like gushing cash flow. I had a friend of mine who had a company that was just like minting money, a private company. And he was like, yeah, I talked to a private equity guy. They had no interest, because they're like, yeah, but you're making money. It's like, yeah, I'm making money. It's a good company. They're like, yeah, can you spend more in marketing just so you could lose money? Like, it was this weird conversation where he's like, what world do I live in where you're valuing a crappy company over a solid company? And I think it's just because there's a certain framework that people are living by, and they're deciding, hey, this is the framework we need. And you try to bring in another company, and you're like, I don't want that. Like, okay, give me that company. Like, that, to me, that sounds like a winner. But I think the Wall Street has gotten kind of has become this new thing that people are just kind of scratching their heads and saying, this doesn't make any sense. So maybe value investors will have their day in the sun soon. I hope so, because God, it's tough being a value investor in the last 10 years. Even though, I'm more value oriented, so I think it's the right thing to do, but that's my preference. Everyone's different, and what really matters is making money. So it doesn't matter what my preference is. What matters is what's going to make money. So I think that's the hard part. But let's get into the last piece before we kind of wrap it up here, which is ESG. So Barb, ESG pros, cons, what's going on? We've seen a lot of changes actually in the last 6 months.
Yeah, well, let's not forget that ESG is really a new field. It hasn't been around a lot, so there's not a whole lot to study with it. And a lot of people will say, well, ESG, it's great because I'm investing with my values. Hey, I even say that myself when I do a lot of writing for different websites, and I write that all the time. But it's not really as simple as that. The ESG factors are not easy to quantify, as you might think. Environmental, social, good governance. They're not that easy to quantify. And so that means they're hard to measure. Sustainability, which is another word for ESG, it's more, the popular term today. The disclosures skew towards process and procedures. So in other words, a lot of the measurement of whether a company is leaning with good ESG metrics is determined by, do they have a statement? Okay, have they paid attention enough to say we have a good governance statement, or we have an environmental positive, and to have positive environmental metrics, that statement. And a company can get highly ranked on that, and there's no measurement of, well, what is the practice? Another factor in the confusion conundrum of ESG is we're all measuring it different ways. Finally, and then I will shut up, you're using ESG metrics across the board to handle different types of companies in different types of regions. You couldn't possibly have a manufacturing company with the same sort of ESG profile as an information tech company. So this is, I gotta say, and be honest here, there are a lot more questions about ESG than there are answers.
I agree with that, Barb. So, Doug, what are your thoughts of ESG?
Well, I have a lot of agreement to what he stated when he said, look, if ESG was going to be implemented at the ideal level that the proponents of it have stated it needs to be, that if you compare it to every other technology that we've seen out there, I mean, look at where artificial intelligence is going right now, and look where space exploration is going right now, and look where any number of areas of technological development are going right now, and they're standing on their own 2 feet. They either have a tremendous level of private investment that is willing to put their own money up to risk to make it evolve to a level of sustainability, or it's just going to fail and evolve into something else. And ESG is one of those things that after all these years, as we've looked at all of these competitive areas of technological advancement, and you compare it to the same technological advancement that's going on with ESG, I believe he's correct in the fact that this is broken to a point in which if it had evolved the same way everything else would have, we wouldn't need to continue to have the subsidies that are needed in order to support it. We wouldn't have to continue to have the mandates and the regulations. It would have naturally evolved into something that would become efficient, effective, everyday usage. But we're going to push forward in that. As a matter of fact, Kirk, we've talked about this, and Barb, I'm going to say that, we have something in common now. Effective yesterday in Minnesota, where I'm at, Governor Walz signed a bill to make Minnesota carbon-free by 2040. So as I live and breathe here, we're going to find out firsthand whether or not this is going to be something that's going to be able to be achieved as an ideal, or we're going to be one of those test cases along the way that's going to prove whether or not this thing is going to work and what the costs are going to be. So I'll keep you posted. I will say some latest news that are out there about some of the wind turbines has definitely been a little ominous. There was an article recently that came out about how a lot of the new technologies, only 3 major manufacturers of wind turbines, they're having systematic failures. They're collapsing, they're falling over, they're breaking. They're trying to find better technology to make them work. But if you put this thing up and this thing falls over and breaks in 10 years, and now you've got something that is actually made out of petroleum byproducts, right? These things are made out of plastics. What do they do with that? Well, they're getting buried. So it's controversial. I know we're touching on things that both sides of the fence are ready to put on the gloves and fight over. But again, we have disposal issues, we have creation issues, and of course, as we go through weather cycles and go through the costs and subsidies necessary, how is it going to continue to be paid for? Are major questions that ESG's got to overcome. And like he talked about, and you've talked about, Kirk, nuclear energy, that's the one that's free, right? But everybody's afraid of it. And so the one thing that can continue to sustain for decades or beyond is one thing that really nobody on that side of the fence wants to touch.
Now, I have a question about that because, of course, we've talked about nuclear energy quite a bit. I've lived through 3 Mile Island. I've lived through all these nuclear disasters. So I have 2 questions. One, is that why nuclear energy is so verboten today? And why aren't people talking about the advantages of that as well? So help me understand this.
Well, you can go back to, again, it's a biased, it's a biased documentary biography for Bill Gates, but they talked about a little bit in the mind of Bill Gates and whether or not you agree with Bill Gates or not. One of the things that they talked about in that was what they were trying to get this and promote this new technology. There's been tremendous advancements. If you look at the way Chernobyl was built versus the next generation of nuclear power plants to what they're trying to do now, to where the biggest problem with nuclear power plants is, of course, is if something goes wrong, how do you stop it, right? The escalating meltdown. So they've created newer technologies now that as these nuclear rods are utilized, they will burn themselves out. It's almost like they create an instant ash. So it's almost like a powder form. And I'm not an expert here on nuclear energy, so I could be stating this completely wrong. But the level of chance of a meltdown has significantly decreased. Again, because this is an area where technology advancement have occurred. They've looked at ways in which not only does the risk get diminished, but the other problem is, of course, what do you do with those spent fuel rods, right? There's areas, many areas around the country, especially in Colorado where I used to live, where they've got sites where they have buried old nuclear reactors from weaponry, from energy plants, and these places are untouchable for thousands, millions of years, right? They're going to have this environmental impact. The technology has advanced to the point where they believe strongly, now we've heard that before, that they do not think that these problems are going to occur with this new technology. But I do believe that what you have still is because of when, even though the odds of a situation occurring with nuclear energy is slim, it's kind of like flying on an airplane, right? The odds of a plane crash are slim. But when one happens, it's a big news event. And we've had such big news events over the years that people are still very skittish of putting something that could potentially have major environmental and personal disaster consequences in my backyard. And it's probably the greatest not in my backyard conversation that exists.
So what's interesting, and I want to touch on nuclear really quick before we get back into the ESG, is I think the problem with nuclear is bad information. I think there's a lot of people who are afraid of, there are situations that happen, right? Like 3 Mile Island was human error, right? And when it comes to what was it?
As was Chernobyl.
Yeah, Chernobyl was also human error in a big way. Fukushima was not human error in the issue, but it was human error in that they were actually told that these issues were a problem. So like the backup generator, they said, backup generator gets flooded, you're going to have a problem. So they raised it above where the water was, but all the equipment that runs the backup generator was underwater. And so I think, it's not like people are like, wow, how did this happen? It's usually, from what I gather, some of the problems are human error. When it comes to building these things, it comes to basically regulatory problems. Like it's so costly and takes forever to build these things where they could be built quicker and easier and more affordably, if you had done things differently. So fortunately, there's a lot of people out there that are actually bringing things out. I was listening to somebody talk about this last week, and there was a really interesting fact of history. So we use the light water reactors. That's kind of the method that everybody uses and has been using for a long time. Did you know that there was a choice between a light water reactor and the molten salt reactor? There was a choice. Molten salt reactor is like virtually impossible to melt down, and it's really, really safe, and there was no problems. And the only reason we went with light water reactors is because Richard Nixon wanted the technology built in his state. So it went to California instead of, I think it was like Tennessee or Kentucky or something, like it was one of those states. And if it had gone in the direction that it should have gone, then we wouldn't have had all these problems. But because it was a politics issue and, hey, we want jobs in my state of California, that's where it went. And so I think the challenge with something like nuclear is it's so highly regulated. I'm not saying it shouldn't be, but it's so highly regulated. You get politics coming in that completely alters the course of history and where things could have or should have gone. So I think one of the challenges that comes with any sort of technology, nuclear being specific, because everyone's afraid of it, is that there's a lack of information out there. There's a lack of clarity. And frankly, if you have enough eyeballs on it, where actually there was I was listening to the recording when Nixon was saying like why we want to do this. It was literally just right there on audio of why he was doing this. So I think if you understand there's a super ton of transparency in the issue and people have a chance to debate it and it's out in the open, then at least we can make informed decisions, right? It's like, the global warming crowd saying that, oh, the debate's already happened. I'm like, when did it happen? I didn't see it. Was it on CNN? Was it on, C-SPAN? Like, I didn't see it. It's like the best science is when people debate an issue and they poke holes in it and they find what the real solution is. I don't know the truth of all the science. I'm not a scientist, but I know that that's when the best science happens, is when it's transparent, when you have people have a chance to say, no, this is wrong. And then you can say, oh, this is a problem. Let's look into it. Let's see if we can fix it. So unless we start having that debate, because right now we're not even having a debate. Right now, it's just too dangerous. And we can't talk about nuclear because, oh my God, something's going to happen. People are so freaked out, they can't even talk about it. So you need to get to the point where we can actually have the conversations around it. And then the consensus in the community comes to, this is the best choice. This is the best choice. I mean, there are private equity guys right now investing in new nuclear technology that is state of the art. And they're just waiting for, the government to come around to actually saying, all right, we need to change something. Well, when that's going to happen, it's going to happen when we run out of energy and people are freezing to death in the middle of winter because of the Ukraine war. And we're pumping, our natural gas over to Europe. And so we don't have anywhere to heat our homes. Or, oh, by the way, energy used to cost, $100 a month to heat your home. Now it costs $10,000 because, the politicians have decided we need to make energy expensive so people move their butt and go into clean energy. Like, that's the direction that they're going. But who does that penalize? Poor people. Well, they're the ones that are going to suffer, and they're going to say, oh, well, we're going to come save the day. It's like, well, you caused the problem, and now you're going to come save the day. This is why I hate politics, because it comes down to a self-serving nature of them, coming to their conclusions, which brings me back to ESG. ESG in itself, I mean, it's a great concept if that's the way you want to go. But the problem is, you have these ESG ratings, which I think is interesting, but who's going to be the judge? Who's going to judge what's right or wrong, right? I mean, you have a person or persons making that distinction. Well, as we all know, people are subject to bias, whether it's on the right or left. I don't care. It's not the point. The point is people are subject to bias. When you have people making decisions for other people and you're forced to make a decision based on an ESG rating that may or may not be accurate. I don't know. I mean, there was a time when I think ExxonMobil was one of the highest rated ESG companies, and so was Philip Morris. Well, of course they had to change that, but it's the point is like people make decisions and they could be right or they could be wrong. But if we're all forced into a funnel based on certain decisions, well, that's not a free market. That's a managed market, and managed markets don't work. And so I think the challenge is how do you get to a point where, because I think we talk about this in the show, everyone wants a cleaner planet. Nobody wants a dirty planet. The question is, how do you get there? We disagree on the solution. We disagree on the path to get there. And I think people need to recognize that is the challenge. It's we're disagreeing on the challenge, on the path, not on whether it's right or wrong. And so, is ESG the right thing? I don't know. I mean, I don't agree with it. I think all of Wall Street, it's like this private joke with the institutional managers, you know, they're all like cracking jokes behind the scenes of how garbage this whole thing is. And they're like, well, this is easy money because investors want it. So we're just going to give them what they want, even though it's not, you know, ESG friendly. I mean, it's a complete joke, but you know, the investors don't hear that. They don't see that side of it. So I think until they do, it's just, you know, Wall Street's going to take advantage of what investors want. If they want something, they're going to give it to them, even if it's garbage. So I think it kind of comes back to the simple point of make good decisions based on a company's financial stability. Find good companies that you want to own. Don't buy based on its ESG score. Buy in whether it's a good company. All else being equal, if you want to tilt towards one or the other, great, do that. But that shouldn't be the defining factor. It should be, is this a good company? Is it producing cash flow? Is it a solid balance sheet? All the important things, focus on that first. And then if you want to make a small bias in one direction or another because of an ESG score, well, you really can't go wrong because you've already made good decisions. But you can't start there, right? It's like saying, I'm gonna save taxes and I'm gonna invest in something because it's gonna save me on taxes. Well, if you don't make money, that's gonna save you taxes too, right? But that's not necessarily the best decision, right? You gotta make good decisions first, worry about the taxes later. So anyway, enough with my rant. So Barb, final thoughts from you as we kind of wrap it up here.
Yeah, great rant. Make your own decisions, like Kirk said, do your own research. And if you just don't want to do any of that, do a little research, choose a good money manager for yourself, and then just stay in touch with him or her. But either way, you're responsible for your money. I'm Barbara Friedberg. You can find me at Barbara Friedberg, Personal Finance. See you next time.
Thanks, Barb. And then Doug, final thoughts from you.
Well, you know, it's hard, as we've determined in these conversations, it's hard to find out what's a good company and what's not a good company and figure out where to invest. So, you know, the best investment is to believe in yourself. And because of that, you know, ultimately, as we stated, we're still, regardless of we might be the cleanest shirt in the dirty laundry, but this is still one of the best places in the world to start a business and be an entrepreneur. And so because of that, you know, if you really want to know where to invest, the biggest way to make your own money, the biggest key to wealth is to be an entrepreneur, to start your own business, start your own path. And if you're one of those entrepreneurs, you know that once you start it, that's the easy part. The hard part is running the company in a way that's going to allow you to still have work-life balance, to create something of value, to have an exit strategy. So if you want to figure out how to build your business correctly, there's actually an ultimate system to get your business to work without you. Owners often feel like the business owns them. Automatic Business Method has a 9-step method that will transform your business in as little as 90 days to boost revenue, create a business performance culture, and get your time back so you can live life on your terms. Get this 9-step business growth 9-step business growth guide to beat back fear, doubt, and create new revenue, even if we go into an increasingly tough economy. You can learn more about that at automaticbusinessmethod.com, or email success@abmfreedom.com.
Great. Well, Doug, really appreciate you coming on the show as well. Thanks for that information. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.